Yesterday at this time, the market was off more than 300 points because of weak economic data that we'd gotten from China. Markets shrugged that off by the end of the day. Will they do the same with this, or when they hear numbers from Apple, is that a more specific concern that it really breaches out for the rest of the market?
Well, it is a more specific concern. I'm saying to remember what's going on. It's M&A, it's the macro and Apple specific. So with the macro, the question is this global slowdown actually going to morph into a global recession? Right now, expectations are that Chinese GDP will be up 6% in 2019 versus the 6.6 projected for 2018. Globally, expectations are for a slowdown, and it's not just in the developed nations, but emerging markets as well. But I don't think a majority of people are expecting a global recession. So, and mainly because they realize that should we come to some sort of trade agreement with China, then that could end up pushing the share prices dramatically higher. When I got up this morning watching Dominic Chu at 5 a.m., I saw the futures down dramatically more than they are right now. Right. So that sort of indicates to me that investors are digesting the news, but still trying to figure out if this is a good buying opportunity. According to S&P Capital IQ consensus estimates, the S&P was trading closer to a 14 handle on forward 12-month earnings on December 24th, which is a double-digit discount to the average over the last 20 years.
Yeah, I mean, you have a lot of the market's in an interesting spot coming into a new year where you have not just the valuation compression of last year, but also just a tremendous concentration of heavy determined selling. You got seemingly a sentiment almost capitulation, if not getting one. But now we're entering this season where just what are earnings going to show us, and what is that E in the PE going to be? Exactly.
In the last 27 quarters, we have seen consistent outperformance by the actual numbers relative to the end of quarter estimates. So 27 consecutive quarters in which the actuals beat the estimates, and the average was 3.8 percentage points. So the question is that going to happen this time around? It has to end sometime. Right now, estimates are expected to be up 13.7% for Q4. That is down from a more than 15% estimate on September 30th. So I think they're edging the bar lower, maybe so they get a couple of penny of beats as we move into this quarter.
You know, from the historical perspective, what do you look at and say, this reminds me of such and such time? Is there anything, or are we kind of off the books at this moment?
Well, you know, obviously, they're actually, by having knowledge of history, I end up sounding like an economist because I've got two hands. Okay. First off is the Fed raised rates 7 times in 1994 into early 1995. When the Fed finished raising rates, the S&P was up 34% in 1995. The Barclays aggregate was up 18.5%. So are we going to get that kind of a recovery in the stock market once the Fed stops raising rates?
Can I ask, how did they signal? How did they signal that they were stopping raising rates at that point? Was it...
First of all, they raised once in the new year.
Right.
By the middle of the year, they were cutting. I think we got a sub 1% GDP quarter in 95.
So it was more of a signal in terms of hawkish tone, the data itself coming in weaker than anticipated, which then, you know, market investors anticipating the Fed would be cutting rates, or at least plateauing and then cutting rates, and that drove the equity prices higher.
That's the bullish example from history.
Oh, that's the very bullish and also very much non-consensus.
Yeah.